Everyone says it, buy the dip, but no one ever shows you the data. What if waiting is actually costing you? So I built a model using every single trading day since 1950 on the S&P 500, literally a smidge over 19,000 in total, to answer one question. Is it better to dollar cost average or buy the dip? What I found, and I'm being 100% serious about this, absolutely shocked me. Now, what is the idea behind buy the dip? Well, you'll hear it all the time, and you tend to hear it during bull markets. Why? Because when a market's going like this, but it does this along the way, every dip feels like a buying opportunity. Makes perfect sense. Now, as you know, what we teach on this channel is the market's gonna do this, but over long periods of time, it's gonna do this. And dollar cost averaging goes along the way. The hard part is, we've been in a market that's basically gone straight up since 2009. We've had a few downturns, of course, but they're very short, temporary, they rebounded right back up. Hence the buy the dip mentality. Because every time it dips, you buy more, it goes right back up. So I sat there and said, listen, there's gotta be an easy way for me to test this out. Because I truly believe in dollar cost averaging. And I have felt that the people I see that say buy the dip tend to be people who don't think bad things can happen. Now remember, I do believe in the long run that stocks will continue to go up as the US economy gets bigger and better, as the world economies get bigger and better. We're becoming a much more global country, and companies here can now sell internationally much easier than 100 years ago. So a growing world will be very beneficial for companies that are based in the US. So I decided this shouldn't be very difficult. Let me settle this once and for all. So here's how I did it. I took a spreadsheet. I imported every single date going back to 1950, not including days the market was closed, only days the markets were open. And I took the S&P 500 closing mark for that date. Now, this does not include any dividends. So everything I'm going to show you here does not include dividends. But the good news is, whether you dollar cost average or whether you buy the dip, in either situation, you'll be getting dividends. Next, I sat there and assumed $20 per day starting in 1950 to dollar cost average. And on buy the dip, I decided to sit there and say, let me do it this way. So I texted a bunch of friends and said, hey, when you hear the term buy the dip, what numbers do you think that is? And everybody gave different answers, and they all said, I never really thought about it, but buy the dip really doesn't have an exact definition. So I thought, okay, why don't I do it this way? Why don't I say, hey, if the market falls where it's down 2% today versus 22 trading days before, because 22 trading days is about the number of trading days in 1 month. So it's essentially 1 month before. I sat there and looked at the data, and literally I was surprised. Now, what I did was, if the today's price versus 22 days ago was not 2% lower or more, I just accrued the money in account. And when it finally hit 2% or more down, I put all of that money in. So for example, if today and for the next 9 days, the market was going higher and higher, that $20 was going in for a total of 10 days and $200. If the 11th day, the market was 2% lower than it was 22 days before, I put all $1,000 in at one time. So it was basically a go all in once that trigger is hit. So it's accumulate, go all in. And if it continues to go down, it's $20 more per day. That's how I did it versus dollar cost averaging. And guys, I was shocked. Why was I shocked? Because what I expected to happen did actually happen. Dollar cost averaging did beat buy the dip, but not by much. Guys, going back to 1950, 2% dip, 22-day look back, $20 per day, assuming no dividends, buying the dip yielded $19.8 million, dollar cost averaging 20.246. That was the difference. Guys, this $400,000 difference is 2%. Difference total over 75 years. Not 2% a year, not 2% a decade, 2% total. This is negligible. You're gonna pay more in fees on the low-cost ETFs than you would have doing this. That's what's amazing. I was absolutely shocked by this. I honestly thought that if this was $20 million, I thought this was gonna be 10 million or so. I thought it wouldn't work. I thought it'd be absolutely terrible. So then it made me wonder, okay, what else can it do? So Tim, the co-founder of this channel, said, Paul, what about if you only buy when the market's going up? So you build on that momentum. I was like, that's a great question. So I did the exact same thing. 2% on a 22-day look back. Well, I'll be damned. Momentum worked, but by how much? $9,000 on $20 million bucks. $20,255,000 versus $20,246,000. Guys, basically the bottom line is dollar cost averaging works. And I also figured out this. If you have a process, a systematic process that you stick with, you will probably do very well. People screw themselves with money by deviating from a systematic process and getting their emotions involved. It was all basically the exact same amount of money. Guys, I want to repeat that. The most important part is finding a set of rules and sticking to it if you don't want to analyze companies. If you remember, we did videos a long time ago on the magic formula by Joel Greenblatt. And what he always says is, listen, the hard part about this is you've got to be okay with underperformance for 3 to 5 years. If you are, my magic formula will absolutely crush the market. The hard part is people don't want to underperform for 3 or 5 years. They'll gladly underperform for 30 or 50 years, but the idea of underperforming for a short period of time is devastating to them. But that's not the way it should be. Guys, one of the benefits of having real estate and business upstairs is I'm able to sit there and say, you know what? If things don't go well in the stock market, I'm fine. I still have real estate and businesses that are worth far more than my brokerage account. The key to all of this is sticking to a process that works. If you stick to a process that over long periods of time works, there are going to be short-term price times where it doesn't work out very well for you. That's not the point. The great news is about buy the dip and dollar cost averages, you just do it systematically. The hard part is this about buying the dip. Guys, if you look right here, on February 2nd, 2018, it was $6,260 that accrued in the account. That is almost a year of never having a 2% down month. So when you finally bought the dip, you put $6,260 in immediately. That's the hard part because you're accumulating this money and if all of a sudden it hits, you're like, oh shit, I got to put all that money in versus $20 a day every single time on dollar cost average. It's all about understanding what makes sense to you. My personal opinion is if they end up being the same amount of money anyhow, just do dollar cost average. You'll get in the habit. You don't have to think about anything because I don't want you to sit there and question this. And going back to 1950, this was the highest it ever got, $6,260. And currently, we're sitting on a time of $940. So if it's been 37 days since we had a time period, we were down 2% from the previous 1 month. Guys, remember back in COVID, we hit a top on February 19th of 2020 and we bottomed on March 23rd, 2020. It was almost a 40% fall in a matter of 4 weeks. This is why it's important to stay the course. You would have never guessed. By the way, when it bottomed, I think we were still weeks away from the full shutdown. We weren't even fully shut down yet. They started talking about the shutdown and parts were shut down, but we weren't fully shut down yet we'd already seen a bottom in the market. So it's really important that you don't look at the news and you follow this process. That can be difficult, especially as money accrues. So if you just sat on cash waiting for the bottom, you'd have missed out on a very quick turnaround. In fact, 2020 ended up higher on December 31st than it was on January 1st, accounting even then for an almost 40% drop in a matter of weeks. Same story, April 2025. Quick crash, immediate rebound, no warning. Trying to outsmart the market sounds smart, but if you miss the best days, you will lose. JP Morgan did a study. Now, I have a caveat to the study, but their comment was if you miss the top 10 days, your return drops by more than half over a 20-year period. That's huge. Now, the caveat to that is, well, if you miss the top 10 days, you're probably going to miss the worst 10 days as well. So they haven't shown that number in there, but it is kind of interesting to say, wow, that few number of days accounts for that much of the gains. What about the top 20? You go from half the loss to about 66% of the gains being gone. Top 30, you're basically even. That's what's crazy. And you don't get to choose when those days happen. They often follow the worst days. The worst days often follow the best days. Even major studies, and guys like Peter Lynch and Warren Buffett, they will back this up. Now, there's a story out there that Fidelity has done a study where they've looked at the top performing accounts, and they were from accounts that were inactive or people were dead. We haven't verified that study actually happened. There's kind of an old wives' tale about that. But There are studies where they show if you bought the Dow 30 in like 1960 and just never did anything, you dealt with the bankruptcies, the acquisitions, you sat there, you outperformed the market by almost 2% per year. That's a lot of money. And Peter Lynch has a very famous quote: "Far more money has been lost trying to anticipate corrections and crashes than in the corrections themselves." But it's hard emotionally to see your money fall 40% in 1 month. Buffett always said the best time to invest was yesterday. The next best time is today. He has praised dollar cost averaging for decades. In fact, he has even said that his instructions to his family when he dies is put the money into the S&P 500. Now, guys, a very, very common question I get is, well, Paul, we're at all-time highs in valuation. You say it all the time. Shouldn't I just wait for a pullback? I believe in systematic dollar cost averaging. I just believe in picking your process, starting and going on. Here's an example. And I've talked about this example all the time. QQQ peaked on March, I believe it was 10th, 2000. From there until August, I think, of 2002, it fell 80%. You wanna hear something crazy? If you started dollar cost averaging on March 10th until now, you made 14% plus returns on your money. Because you know why? When the market was 80% lower, then QQQ was 80% lower and people gave up on it, you were buying massive value. On the S&P 500, if you did the same thing, you were still doing 11 or 12% today after seeing the S&P fall twice by over 50% in the next 10 years. You're still making over 11% returns. That's incredible numbers, guys. You've got to remember that that's why guessing is not going to work. You've got to keep doing it the way we talk about it. Pick a process and stick with it. So what's really interesting to me, guys, is the same thing I did with my buddies. It's not that buying the dip is a bad idea. It's that people don't know what buy the dip means. It's so subjective. And guys, analyzing a company can be subjective. But I will tell you that the best investors out there pick a few metrics that work and they stick with them and they buy systematically. When they try to time the markets, people don't do well. DCA, dollar cost averaging, works because it's a rule. It forces you to act even when your emotions say otherwise, because discipline beats intuition almost every time in investing. There's an old saying about investing that it's one of the few areas that the more you do, the worse you do. Sit on your hands. That's what you're paid to do, as Charlie Munger says. Charlie Munger says the money is made when you sit on your hands. Now, at the end of the day, yes, dollar cost averaging won, but not by enough for me to go, God, it's so obvious. However, I still believe it's better because of the times when you accrue more and more money, it will be hard to pull the trigger, especially if it's the start of a downfall. Now, guys, one thing I did do here, I changed things around here. Let's change it to 5% dips every 30 days. Guess what? 20.246 versus 19.2 million. You know what's crazier? The largest account balance was 13,180 at deploy at one time. Let's go lower. Let's go 1% on 20 days. Dollar cost average still works. But buy the dip was still close to the number, 2 or 3% away. And the other thing is how disciplined you have to be when you have 4,000, 13,000, 6,000 to not go splurge on something. Well, the money's not getting invested anyway. Let me go splurge on something. That's difficult to do. That's why even though the numbers are close, first off, dollar cost average still works. But second, it just makes it a lot easier to not see a big amount of money in the account. That's hard to do. Guys, I'm very disciplined. I don't let any money enter my personal spending account unless it's to be spent. Every dollar that I want saved goes right into my brokerage or else I will spend it. And I'm a pretty disciplined guy. So guys, we did this survey and we asked people, why do you watch investing videos on YouTube? There were over 2,700 votes. Guys, 86% said to get ahead and get better. This means you're someone who likes to learn. If you like to learn, you will do very well in life. Charlie Munger always says, I've never met somebody super successful who didn't have a desire to learn. That's what's awesome here. And if you're trying to make up for lost time, like 10% of the people, dollar cost averaging is a great place to start. So I want you to do 2 things for me. First off, we have a free PDF, gets emailed to you in a matter of 1 minute. Click the link below. It's on dollar cost averaging. It'll explain everything we believe about it, and it'll be very informative for you. So make sure you do that. The second thing, watch our next video. It's our ETF video where we talk about dollar cost averaging and ETFs. You'll absolutely love it. Do both those things and you'll end up being smarter than 99% of people out there. Thank you for your time.